You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It is 8/12/21. Well, if you'd listened to this person a couple of months ago when we had him on, you would have been probably selling your gold in May or in June and then going away. But if you're like me, you probably didn't. But he was spot on. He's been really spot on with his precious metals predictions for years. And also, you would have sold your oil as well because he called the top on there, and it looks like it's happening. I'm talking about Eric Hadik. Eric's site, your site, Eric, is Inside Track Trading, and that's Inside, INSIIDE, tracktrading.com. Eric, it's great to have you back on, and we can't wait to hear what your latest prognostications are on a variety of markets.
Well, it's great to be back on, Kerry. Thanks for having me back.
Always so. Hey, and if you got a question for Eric, I'd urge you to send me an email. We'll make sure it gets off to him and you can get an answer. So first thing we got to cover, Eric, even though it's not really first on my list, is precious metals, because you really nailed it.
Well, I've been, as you know, with our discussions over the last several years, I've started out looking at gold from a very broad perspective. And, that kind of lays the backdrop. It's not something necessarily you trade specifically off of, but it's where to set the stage. And what I have described since, 2015 was this 40-year cycle of currency wars, is what I called them. And you can go back through America's history right to the Revolutionary War and the issuing of continentals. And you could see that every 40 years, without fail, there has been this real resurgence of a battle between paper or fiat currency and hard or precious metals currency. And each time it has kind of set another knock into gold. And even though gold might move up during some of those phases, the steady progression has been just reinforcing the love for paper currency, for fiat currency, for debt-backed currency, and the just dislike of gold. And we came into this year, in fact, if you go back and just give a quick recap. So you had the continentals, the first experiment with paper currency in 1776 through 1781. That was an all-out bust. By 1781, they were gone. They were worthless. And then every 40 years from there, 40 years later, in 1816 to 1821, you had a big battle over the chartering of the Second National Bank, which then led to inflationary moves, and the whole thing culminated 1821. Then 40 years later, 1856, you had the government was reducing the amount of silver in coinage, and it led to a suspension of silver and then a suspension of gold currency between 1856 and 1861, led to massive inflation right into the Civil War. 40 years later, you had a big battle over the gold standard and the Cross of Gold speech by William Jennings Bryan, and everything about that. And that was one little victory for gold, where the U.S. reestablished the gold standard. And so that phase went from roughly 1896 to 1901. Same even year numbers on a 40-year basis. Then you had from 1936 to 1941, the really a little before that, but first the confiscation of gold and silver, outlawing them, and then the ramifications. Then in 1976 to 1981, 1976 was kind of a final divorce decree where not only the U.S., but most industrialized first world countries joined in on the Jamaica Accord, which was basically a divorce decree between fiat currency and gold. And from 76 to 81, you had this whole inflationary period. Anyone that was around then and in the markets remembers what gold and silver did during that time. And that brought us into the current, the most recent decade. And so starting in 2015, I was talking about how I thought 2016 would start a similar battle and a similar phase. And even though it's not always right in your face, very overt, that the markets would reflect that there was a battle going on between gold and paper currency. And that 2016, I did several reports back before then saying it would be the golden year that would initiate a new bull market in gold leading into late 2020, early 2021. And there were a lot of other reasons other than just this big, broad 40-year cycle. But the outlook was for gold to see another strong advance from 2016 into late 2020, early 2021. As we got a little farther along, in late 2018, monthly and weekly cycles were starting to align closer. And it told me to look for two important highs, one in the third quarter of 2020 and the second one in May, June of 2021. And that I thought that would be kind of the topping phase of gold, silver, gold shares. And that is why in our previous discussion, I was just reiterating that entire analysis and showing that near-term analysis, near-term cycles, price indicators were reinforcing that we had seen what was at least a 6 to 12 month peak back in August of 2020, and that May, June of 2021 was when you should see a subsequent peak, higher or lower, and things would begin to turn more negative after that. And I think that's where we find ourselves now, still just kind of like a roller coaster that's just barely going over the peak, but isn't quite ready for an accelerated move down.
So with inflation that's taking place now, purportedly transitory, of course, I guess if we're all broke, there can't be any inflation, right? But with the inflationary move that's happening now, is that going to be the impetus for the next upswing in gold?
Well, as you know, the markets always discount things at least 3 to 6 months in advance. And really, this price inflation has been going on since things hit rock bottom in late March of 2020. And you started to see the first leg up into third quarter of 2020. Then late last year, early this year, things started to accelerate a bit more. In fact, at the time, back in 2020, you already had things like grain markets, soybeans surging to multi-year, multi-decade highs, and other commodities like lumber going from where it was around $300 a board foot on the futures market to ended up peaking over $1,700 a couple months ago. So that whole inflationary move is pretty much already in the books. And gold had its first move up into August of last year, and then sold off into late March of this year. And then as a lot of these inflationary and commodity markets were surging again, it had another surge, but a bit more anemic than the one before it. And so even that is the type of thing that you need to be wary of, that you look at a correlation like that and you see all this inflationary move going on that's just starting to hit the numbers now. But if it's hitting our numbers like today's CPI, then it's already factored into the markets and has probably been factored in for weeks or months. That's the problem, that some of your more novice traders see a news item and suddenly decide it's time to go trade on it. Well, that trade's already long gone. that train's not only left the station, it's pulling into a different station. And so it's the buy the rumor, sell the news, or buy the expectation, sell the realization. And I think that you're going to continue to see some of these inflationary numbers come out, but I think you're going to see it starting to taper a bit. And if it's already factored into the market, a little bit of additional upside, even on a percentage basis, is not going to be near what we experienced over the last 18 months. And so gold needs to look for something else to drive it higher or lower. And one of my other analyses that could be a bit of a weight or a burden for gold over the next 6 to 12 months is what I'm looking for in the US dollar. And I think that it has set probably a 1 to 2 year bottom, and is just in the very early stages of starting to recover. And that could be for a number of reasons. It could be things that aren't even evident yet. But from a cyclic and technical basis, everything is arguing for a significant bottom. That doesn't mean that it's going to suddenly skyrocket, but if it's on a general upward trend, and if inflation is starting to cool a little bit, and if you start to get interest rates ticking up, or at least the expectation for them, that's one of the biggest burdens on gold, is just even that expectation that interest rates are going to start to tick up a bit. So you've got some headwinds coming at gold, at least on a 6 to 12 month basis.
All right. So then this all ties in with the stock market as well. It looked like it was peaking, and now it looks like perhaps it's getting ready for another advance.
Don't just survive, thrive. The Financial Survival Network.
Today's show is brought to you by Mustango River Resources. Their flagship projects are located in Kirkland Lake, an established gold camp that has historically produced over 70 million ounces of gold. The Kirkland West project is a high-grade gold project beside Kirkland Lake Gold's world-class Mikasa gold mine, one of the highest-grade mines in the world. The Umeja project is an advanced stage project with 600,000 plus ounces of gold along the Cadillac Break, 25 kilometers east of Mikasa. Their projects have the potential to transform into another world-class mining camp in the Kirkland Lake District. Make sure you go over to Mustango.com. That's Mistango.com. Take a look and sign up for notifications. Stock is traded on the Canadian Stock Exchange, ticker symbol MIS. For more information and to sign up for notifications, go to Mustango.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Well, I'm thinking that you're due for a second correction here in August and September. I thought that we would see a pretty significant high in most indexes and most stocks in May and June. And it is funny to me how closely things like the precious metals and stocks do set their major highs and lows, even though there's just enough of a separation usually that whichever the lagging one is can have a huge move right at the end and completely outdo the other. But yet, if you're just looking at when they topped and bottomed, it's often within weeks of each other. And a lot of these stocks had a very consistent 16-month cycle that last timed the peak in January and February of 2020, right before a 40% plunge in late February and March of last year. It timed the September, October 2018 peaks right before we saw sharp 20-25% drops in the third quarter of 2018. And that cycle came back into play in May and June of this year. And that's why I thought that a lot of these stocks and indexes would start to peak then and probably enter a 4 to 5 month corrective period with the next intermediate cycle low not expected till September. But at the same time, every interval of that 16-month cycle and just about every one of your intermediate tops and bottoms in the in the stock market. I guess I should say more tops. You've got certain stocks, certain indexes that hang on to the last minute, and they continue to set new highs, although they rarely have follow through after setting those highs. But the S&P 500 and the NASDAQ 100 are like that, and that's just what happened in third quarter of 2018 and first quarter of 2020. And sometimes it comes down to 5 to 10 stocks that are creating those new highs, even as the rest of them are slowly topping and rolling over. And nobody sees it because all the news is doing is throwing out the numbers of those couple of key indexes. And so it sounds like everything's great, even though 80% of the underlying stocks have already topped and are slowly turning. And I think that's kind of where we're at. I'm looking for, like I said, August, September to be another corrective period. And this time, I think things like the NASDAQ 100, some of the tech stocks are going to see a moderate sell-off in that period.
All right, that's interesting, and certainly wouldn't come as a shock. This market's just been really charging forward, and like you were saying, one other aspect is that 20% of the publicly traded stocks out there aren't making any money. They're kind of zombie stocks. I think there was
right.
200 on the NASDAQ 100 or 20% or something like that on the NASDAQ 100. I don't remember which index, or maybe it was the Russell. 20% are just kind of dead in the water. So.
Right. So it doesn't take that much of a few stocks that are heavily weighted to drive the index to new highs, even if 5 times as many or 10 times as many are drifting lower.
Interesting. So you mentioned higher interest rates.
Yeah, I have been talking about and illustrating a very consistent 4-year cycle in bonds and notes, which trade inversely to interest rates, obviously. And that 4-year cycle has just been uncanny since the 1990s, and it's followed a textbook, the tool I use, a cycle progression kind of sine wave that I illustrate on a lot of my publications. But it just followed that perfectly, setting peaks in July of 2012, July of 2016. And then I was looking for a similar one in July of 2020. We got it kind of right on track. And from there, I was and have continued to look for about a 2 to 3 year decline in bonds and notes, which would be a gradual uptrend in the underlying interest rates. And again, that doesn't mean that interest rates are suddenly going into the stratosphere, but it does mean that bottom should hold for at least a few years and potentially much longer, bottom in interest rates. And so it's usually towards the end of that initial corrective phase. So if I think that bonds and notes are heading gradually lower into late 2022, early 2023, and interest rates heading higher into that time, it's usually towards the end of that cycle when you get the more significant move that markets will often just very slowly, steadily trace out their trend, whatever that trend may be, for the first 80% of a cycle, or sometimes 90%. And then it's that final 10 to 20% when you get 80 to 90% of the actual price move. So, it's something I aptly call the 90-10 rule of cycles, but I'll show how, especially in markets like precious metals, stock indexes, and I've seen it in some of the interest rate markets too. That's a very consistent principle or axiom to follow. And so any bigger move in interest rates could easily wait a year or more from now. But I think that the general trend and expectation is going to be for rising interest rates, and that you'll steadily see that expectation grow in conviction and in more wide acceptance.
All right. Interesting. And finally, we have oil. You had called the peak somewhere in that 77 range, I think it was. 70, 80, $80 a barrel.
75 to 77 was the 6 to 12 month upside target that I had. And it's also funny to me, I mentioned the correlation that you sometimes see between precious metals and stocks. There's also a very close energy equity correlation. And of course, some of that is just due to economic activity. If economic activity is on the rise, then you'll see both oil prices and stock prices heading higher. And if expectations of that start to peak, you'll see both of them peak in close proximity to each other. And crude had its own very distinct cycles, peaking in late June, early July. And it was right at that major upside target I had. And so it was just a textbook setup for at least a 2 to 3 month peak. And I think it could stretch even a little longer than that. And lo and behold, we've got this morning, the market got spooked a little bit when news of Biden and the White House coming out and calling for OPEC and OPEC Plus to start to raise production a bit more than they've said they're going to. So you might start seeing the beginning of a at least psychological or media type war there, trying to apply some pressure and at least getting price to respond, even if the actual event doesn't materialize. And as you and I were talking a little earlier too, talking about just the demand in China having such a drop off here, and in other parts of the globe as the Delta variant spikes higher and more mitigation measures are implemented, and the demand for oil starts to tail off a bit. It's the classic pendulum scenario too, that when we spiked up to 75 to 77, doesn't mean that the fundamentals at that time necessarily justified that price. Maybe they justified 70 to 72 over a elongated period. But the market's always, and the pendulum always swings farther than it should. So then when you get a news item that kind of brings everyone back to reality and all the bullish psychology suddenly gets tempered a bit, you not only have to go back to what the real justified price is, but then the pendulum swings farther beyond that. And so it wouldn't surprise me to see crude over the next few months drop as low as $57, $58 a barrel. But that is very critical 6 to 12 month support. So that's where I'd be watching for a bottom if it gets down that low. But I think that could be kind of an overreaction to some of this news, and maybe OPEC Plus will come out and bump up production a little, or you'll start to hear about other oil producing nations coming online a bit more. It can be all kinds of things, but the technicals and cycles have already waved this red flag weeks or months before the fundamentals finally kick in and people start to react to them.
Right. All right. Well, hey, that gives us a lot to chew over here. Covered a lot of material, but looks like gold doldrums are here for a while, and interest rates are going higher, and oil prices probably lower or have stabilized, and the stock market, well, we're going to see a correction in August and September. So we're in August now, so it won't be long. And if you want to know more, then you need to go over to Eric's site, insidetracktrading.com. That's INSIIDE tracktrading.com. And if you got a question for Eric, just to send an email to me, Kerry Lutz, KL@kerrylutz.com. And make sure you sign up for our free newsletter, financialsurvivalnetwork.com. Eric, always great having you on. Really insightful and really thought-provoking, I guess you would say, predictions, forecasts for the future. And I guess we're gonna step back now and see which ones and how many come true.
Well, thanks for having me, Kerry. It's always a pleasure.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.